Hey everyone, welcome back to our channel where we break down the best books on investing and business. Today we're diving into the Essays of Warren Buffett, Lessons for Corporate America, a collection of letters and writings from Buffett himself. Think of this book like getting a direct line to Warren Buffett's brain for under 20 bucks. These letters are full of amazing advice, and today we're going to uncover Buffett's secrets to building long-term wealth. So, grab your notebooks and let's get started. Alright, let's dive right in with the first big takeaway: the power of long-term investing. Buffett approaches investing like buying a business, not just trading stocks. He looks for companies with strong fundamentals, a competitive advantage, and a trustworthy management team. And when he finds them, he's in it for the long haul. Think about it. When you buy a house to live in, you're not checking its value every single day, are you? Buffett applies this same logic to stocks. He's not fazed by short-term market fluctuations. Instead, he focuses on the company's ability to grow and generate profits over time. This long-term mindset allows him to ride out market downturns and come out even stronger on the other side. The key takeaway here is to shift your mindset from a short-term trader to a long-term owner. Look for businesses you believe in, with a durable competitive advantage, and hold on to them for as long as they continue to perform. Now let's talk about another one of Buffett's core principles: intrinsic value. This is all about looking beyond the stock price and understanding the true worth of a company. The stock market can be emotional, with prices fluctuating wildly based on news, speculation, and even fear and greed. But Buffett teaches us to ignore the noise and focus on what really matters: a company's underlying value. This means digging into its financials, analyzing its earnings, assets, and future prospects. Think of it like buying a used car. You'd want to know its history, condition, and actual worth. Investing in stocks is the same idea. The stock price is just what the market thinks it's worth at any given moment. Intrinsic value represents the true worth of the business based on its fundamentals. Buffett looks for opportunities to buy stocks trading at a discount to their intrinsic value. Focus on the fundamentals, understand what a business is truly worth, and don't get caught up in the market's short-term mood swings. So, we've talked about long-term investing and intrinsic value. Now let's add another layer of protection to our strategy: margin of safety. This concept, borrowed from Buffett's mentor Benjamin Graham, is all about minimizing risk and protecting your downside. Think of it like crossing a busy street. You'd wait for a break in the cars, maybe even a crosswalk signal, just to be extra safe. Margin of safety is your investment crosswalk. It's about buying stocks at a significant discount to their intrinsic value, giving you a cushion in case your analysis is wrong or unforeseen circumstances hit the company. By having a margin of safety, you're essentially buying insurance for your investment. If things go south, that discount acts as a buffer, protecting you from significant losses. Remember, as Buffett says, the stock market is a device for transferring money from the impatient to the patient. So, next time you're evaluating an investment, ask yourself, how big is my margin of safety? Now let's talk about something that's absolutely crucial to Buffett's investment philosophy: integrity. I'm talking about seeking out companies led by ethical, honest, and competent management teams. For Buffett, investing isn't just about numbers, it's about people. He believes that a company's leadership is a major indicator of its long-term success. Would you rather invest in a company run by a CEO known for their integrity and long-term vision, or one constantly embroiled in scandals? Buffett understands that even the best business model can fail with the wrong people at the helm. He looks for leaders who are transparent, accountable, and treat their shareholders like partners. He wants to see a management team that's invested alongside him, with skin in the game. Assessing management integrity can be tricky, but there are clues you can look for. Pay attention to how the company communicates with shareholders and their history of ethical behavior. Aligning yourself with companies that have strong leadership and a commitment to integrity isn't just about feeling good about your investments. It's about protecting your capital and increasing your chances of long-term success. Chapter 5: The Shareholder-Centric Model. Investing in companies that prioritize your interests. This is all about investing in companies that prioritize the interests of their shareholders, treating them like true partners in the business. For Buffett, it's not just about extracting profits from a company. It's about investing in businesses that align with his values and treat their owners with respect. He believes that companies should prioritize long-term value creation over short-term gains. Shareholder-centric companies also tend to have strong corporate governance practices. They have independent boards of directors, fair executive compensation structures, and a focus on ethical behavior. These companies understand that their success is directly tied to the success of their shareholders. By investing in shareholder-centric companies, you're not just aligning yourself with ethical and responsible businesses, you're also increasing your chances of finding companies that are dedicated to growing your wealth over the long term. Look for companies with a track record of paying dividends, buying back shares when undervalued, and making acquisitions that benefit shareholders. Chapter 6: The Power of Corporate Culture. Investing in companies with a winning mindset. Buffett understands that a company's culture is like its personality. It shapes how decisions are made, how employees are treated, and ultimately, how successful the business will be. He believes that a strong corporate culture is a major competitive advantage. At Berkshire Hathaway, Buffett has cultivated a culture of autonomy, trust, and a focus on long-term results. Evaluating corporate culture from the outside can be tough, but there are clues you can look for. Pay attention to how the company treats its employees and customers. Do they have high retention rates? Are they known for being a great place to work? Are they transparent and honest with customers? Investing in companies with a positive and ethical culture isn't just about feeling good about your investments. It's about aligning yourself with businesses that are more likely to make sound decisions, attract and retain top talent, and ultimately outperform their peers over the long term. Chapter 7: Understanding Risk and Diversification. Investing in what you know. Buffett has a unique perspective on risk. He believes that risk doesn't come from the market itself, but from not knowing what you're doing. Many investors view diversification as the main way to mitigate risk, but Buffett prefers a more concentrated approach. He believes that by focusing on a handful of businesses that he understands deeply, he can better manage his risk. Would you rather invest in 50 companies that you know a little bit about, or 5 companies that you understand inside and out? Buffett would argue that by focusing on a smaller number of high-quality businesses, you can make more informed decisions and reduce your overall risk. This doesn't mean you should put all your eggs in one basket. Diversification is still important, especially when you're starting out. But as you gain experience and knowledge, don't be afraid to concentrate your investments in your best ideas. Remember, the key to managing risk is understanding what you're investing in. Do your research, analyze the businesses, and invest in companies that you believe in. The Enduring Wisdom of Warren Buffett. Timeless lessons for every investor. By focusing on long-term value, practicing patience, and aligning with strong leadership, Buffett has built one of the most successful companies in history. Remember, investing is a marathon, not a sprint. It's about finding great businesses, understanding their intrinsic value, and holding on to them for the long haul. If you enjoyed this summary, be sure to give it a thumbs up, subscribe to our channel for more valuable book summaries and investing insights, and share this video with anyone who wants to learn from the best. Thanks for watching, and happy investing.